Welcome everyone to today's session. My name is John Versace. I'm the Head of Expat Services and a Senior Financial Advisor here at Apt Wealth Partners. Today's session is all about employee share schemes for US Australians. So for those lucky enough to be a part of an employee share scheme, they can really provide a great lucrative opportunity to build your wealth and share in the success of the company you're employed with. But they do come with some tax and other financial considerations that you need to navigate quite carefully. And as with all these financial considerations, they get more complex with US Australian taxes in the mix as well. So today we are joined by the tax experts in the US Australian space. So we've got Khandra Wong, who's a US accountant here in Melbourne. Hey, Khandra.
Hi, morning, John.
And we've got Brad Murphy, who is an Australian accountant and tax lawyer with a specialty in expat matters. Hey, Brad, how you doing?
Good, John. How you doing?
Good, thank you. As with all these webinars, just need to go through our general advice disclaimer. So today's session is general in nature. We obviously haven't considered any of your personal financial circumstances in delivering this webinar today. If you are looking for personalised advice, please reach out to myself or Khandra or Brad or any other suitably qualified professional to get personalised advice around your personal circumstances. So just a bit of housekeeping as well. So today's session is recorded. So if you do need to take off early, please feel free to do so. Everyone that has registered will get a copy of this recording sent to their email within the next week or so. Just sometime in the next week, we'll send that through. Also, if you've got any questions along the way, please feel free to pop that question in the Q&A box on your screen there. We'll have a section at the end. We'll try and answer as many of those as possible. Any of the ones we can't get to, we'll give you the opportunity to reach out to us so we can discuss that individually with you. So just to give you a bit of background on the presenters. So firstly, myself and the company I work for, Apt Wealth Partners. So Apt Wealth Partners is a financial advice firm based here in Australia. We've got offices in the Melbourne and Sydney CBDs. We've got around 85 staff across our locations, and we look after around $3 billion on behalf of our clients in wealth and superannuation portfolio assets that we're directly providing advice around. And importantly, we look after US Australians. So we've got a specialised division that specialises in assisting cross-border individuals, but in particular US Australians. So as we were about to go through, there are some really specific areas that you need to really understand when providing advice to US Australians. So that's something we've got a lot of experience and expertise in. So we've got a lot of clientele that live either in the US as Aussies living in the US or US citizens living in Australia. So our advice is really putting together full financial strategies for our clients in working out exactly how they should be setting up their finances to achieve their financial goals. And then we're there on an ongoing basis to make sure our clients stay on track and navigate the moving parts of their financial situation over time. Brad, did you want to go through a bit about yourself?
Yeah, thank you, John. Yeah, so our firm, we're a specialised boutique Australian international tax firm. We focus solely on international taxes and expats for Australians around the world. We have offices in Melbourne and Sydney and a team of 13 looking after our clients. And similar to John and Khandra, we have a big focus on the Australian US system. It's probably our key market. And we work together with John and Khandra to give a joint and integrated tax and financial advice. And yeah, we've been around since 2018 now. Time flies. And yeah, certainly I think the biggest market we're seeing is certainly the US market, for our clients in terms of complexity. I think getting that joint and integrated advice is really key.
Thank you, Brad. And Khandra, over to you.
Yeah, thank you. Hi, everyone. Good morning. I am a Canadian who fell into the U.S. tax system after I graduated university in California, and I've never looked back. So it's been 20 years now since I've started doing U.S. tax returns with a really special focus on international issues. So U.S. citizens that live abroad or anyone who's moving into the U.S. tax system and finding themselves with a filing requirement. About a year ago, I went out on my own and started my own firm, kind of drawing on all the knowledge and experience that I've gained in the last 20 years. Worked in the US, Canada, Australia, the UK. So I think I'm in a good position to really understand how difficult it is to manage your tax affairs across locations. I'm very happy to be here this morning and working with these guys to provide that integrated service that Brad mentioned.
Yeah, thank you, Khandra. And a little more on that integrated service. So Brad, Khandra and I work together across multiple clients for an integrated offering. It's so important. There's a lot of crossover between what all three of us do in the financial strategy, the US tax, the Australian tax. And it's so important that all the professionals that you're dealing with understand how the US and Australian tax and financial system interact. It's no good having, one professional that understands, but then another professional over here that's making plans around your financial future that doesn't understand the crossover. And we've seen, in the financial advice space, we've seen some disastrous strategies on how to set up your finances when there's US taxes in the mix. And no doubt Brad and Khandra have seen similar things with other professionals they've worked with and seen because it is very different. So we do team up, and for those clients that are wanting a very integrated, holistic service, we run joint meetings for our clients. We speak to each other most days. It's making sure that everyone's on the same page. It's very seamless and very easy for the clients that are wanting a fully integrated offering across the full financial and tax affairs. Anything to add there, Brad or Khandra?
No, I think you covered it.
I think it's a good summary, John. Yeah, I think that's a good point. I think the nature of the US and Australian systems, it is quite unique and quite complex. In particular for US citizens in Australia, right? There's certain investments that they really need to stay clear of. So I think it's one tax system. You really need joint advice on both the Australian and American side for sure.
Yeah. So, yeah. All right, so kicking into the presentation. So we'll start off just by going through some of the common employee share plans that you can see in the US. So over to you, Khandra,
Yeah, thank you. Hopefully I could run through this relatively quickly, but I think actually where I'd like to start is I'll switch it around a bit and cover some information on incentive stock options. So for context, these 4 plans that I'm going to talk about are the most common types of equity compensation plans that I've seen over the course of my career. And if you are working for a US company or you're considering applying for a job with a US company, I think these are the ones that you're most likely to see. So we'll just go through these in real quick detail. And just a note that this information is basically all on the idea that this is a publicly listed company, so trading on a stock market. I don't think we have the time to cover private shares at the moment. So with all that being said, I'll jump into incentive stock options, or ISOs. These are also known as statutory stock options or qualified stock options in the US. And that is basically because they have qualified and met the requirements to have special federal tax treatment. So I'm going to talk about 4 sort of milestone events in the lifespan of an ISO, and these words you're going to hear come up time and time again over the course of today's conversation. So the first kind of milestone with an ISO is what's called the grant date, and that is when the ISO is issued to you by your employer. From there, the ISO is subject to a vesting schedule, which over the period of that vesting schedule, you will gain ownership of the option. And that option is the option to buy shares at a certain price over a certain period of time. And you can exercise that option, which is the next milestone. And that is when you actually purchase that share at that predetermined price in the plan. And then eventually you can also sell your share. So that's the next milestone to talk about. So as I mentioned, ISOs, incentive stock options, they have special federal tax treatment in the US. And what it means is the taxing point in the US, assuming you meet certain requirements, is not at grant, it's not at vest, it's not at exercise, but you will pay your tax when you sell the shares. So that is what makes them really special. If we have time, we can go back and talk about what requirements those are to get that special tax treatment. But in the interest of time, I'll just mention that there's also some other complexity in the US around alternative minimum tax, or AMT. So I think you will always see this come up when you're talking about incentive stock options. AMT, or alternative minimum tax, is a concept in the US tax system that essentially makes taxpayers calculate their taxes twice, and you have to pay the higher of the two. So AMT was brought in to attempt to close a lot of loopholes that wealthy people used to save on taxes. So it's just meant to make sure that everyone pays their fair share. And due to the way that AMT tax system works, incentive tax option, ISOs can have AMT implications. So I'll leave ISOs there for now. And we'll move on to the next type of stock option, which we refer to as NQSOs, or non-qualified stock options. And we call them non-quals because they don't meet those requirements to have special federal tax treatment. So the way that NQSOs operate is very similar to ISOs, but instead of deferring our taxing point to the sale date, the taxation point happens at the exercise date. So you are granted an option, the option vests, and then when you exercise it, the tax implications come up. It's important to note that if you are working for a US company and you exercise non-qualifying stock options, there is a payroll withholding obligation. So typically what happens is employers will allow you to sell a number of shares at the same time as you exercise them. And you use those sales to fund the withholding tax. That's what we call a sell to cover event. ISOs are not subject to withholding tax. So if you do have ISOs, you need to make sure that you're saving enough tax in order to pay the tax bill when it comes. Moving along, we'll talk about restricted stock units, which are very, very different in concept to a stock option. So restricted stock units give employees a specific number of shares that are subject to a vesting schedule. And on the date of vest, that is when the ownership transfers to the individual, and that is when the US taxing point is. So again, there's no real value to you until those shares vest, and because the vest is the taxation point, there is also a withholding obligation in the US on RSU income. So again, the typical way to do it is a sell to cover. So you'll sell some shares on the same day as the vest. That gets withheld and paid to the tax offices. If that's not an option, you need to have, or you don't want to sell, you need to have the cash on hand to pay the tax bill at that time. Then moving along very quickly to employee stock purchase plans. These are also called ESPPs. That's simply when employees have the ability to buy company shares at a discounted rate. Typically, I see 15%. I'm sure it can vary with company, but I think I've always seen 15%. So during certain windows of the year, employees will be able to have a payroll deduction and either flow a percentage of their pay or a dollar amount of their pay into a plan. When the window closes, the company uses those funds to buy shares on behalf of the employees, and there is a taxing point on the purchase date. So that 15% discount or bargain element or whatever the percentage is subject to US tax at that point of time. Unless, of course, you meet other qualifying events, and many times you can defer the taxation to a different point, which is the time that you sell the shares. But again, the tax treatment can vary depending on the different requirements that you meet. So even though it's a relatively simple concept, there's still a lot of complexity sort of built into ESPP plans. So I think I can leave that there, just a very brief and high level overview, but I know, Brad, you've got a lot to get through as well. So US tax considerations, which I think we're going to come back and talk about a lot of these topics again, but again, understanding what your actual taxing point will be and what your withholding obligations are, because you may have the chance to defer the taxing point depending on a different holding periods that you have. So really important to understand the taxing point. If you are a US citizen that has Australian employee share scheme, particularly if they're under a startup concession, which Brad is going to talk about a lot, you should really seek tax advice. There are a lot of mismatches between what is a concessional tax treatment in Australia and how the US is going to view that type of foreign plan. So make sure that you understand how that is going to work for your personal tax situation. Again, understand that if your company does not allow sell to cover, or if that's not an option, understand that you need to come up with the cash to fund the tax yourself, and make sure you know when that tax is due and when you need to pay it. And lastly, again, I think this concept is going to come up again, but if you are, as an example, someone who worked in the US for a period of time, earning any type of equity compensation, and then moved to Australia at some point, just be aware that your tax situation will definitely get a lot more complicated. There is a concept of, basically paying to Caesar what is Caesar's. So the US potentially will still exercise their right to tax your income, even if you've moved away from the US. There could be withholding obligations, payroll obligations. So if you're planning a move or you've had a move in the near past, definitely recommend some personalized tax discussions there as well. I think that's all for me.
Perfect. So yeah, over to you, Brad, to talk through some of the Australian considerations.
Yeah, thanks, Khandra and John. Yeah, so I think maybe a good starting point would just be to expand on Khandra's overview of the various tax plans that we see in Australia. There's really two types of key plans we see in Australia. One is the deferred income plans, which are really RSUs or shares for public companies or larger Australian companies, or options for smaller companies. And typically we see options being issued for smaller companies, for startups and smaller companies. And as companies become larger or go public, it's almost always shares or RSUs at that point. But having said that, the tax treatment is very similar between options and shares in Australia. The big exception being that Australia does offer a startup concession plan, which is very lucrative for employees of startup companies in Australia. And we'll dive into that in a moment as to why, but they're the sort of two types of plans we see in Australia. I think a really important point, a bit of a misconception we see, is that what drives the tax treatment and taxing rights is not where the plan is located or what company issues the plan, but rather where the employee is tax resident and where they're doing the work from. And this is a big I guess, misconception we see amongst our clients. For example, if you're an Australian tax resident doing the work from Australia and you've got RSUs in a US company, the taxing rights would almost always fall to Australia on that and not the US, and same in reverse, funny enough. So I think it's really important to understand that concept that Khandra spoke about regarding sourcing, especially if you're looking to move between the two countries on a different payroll as well. That's probably the biggest issue I think we probably see in practice is who gets the tax treatment and how it's sourced. And I'll just touch on that now because it is quite important. Effectively, how these rules work for global expats is that the sourcing country gets a taxing right. So Australia would tax the Australian employment days from the date of grant of the share option to the vesting date, as would the US. And so it's really an allocation between those countries as to how much you declare on each income tax return and how the tax credit flows between the two countries. I mean, luckily, there's obviously a tax treaty to alleviate double taxation. You never pay double tax, which is great. But it can create some funny issues sometimes if you're on different payroll in particular. And the backdrop there is also important on the reporting side in that an employer in Australia has an obligation to report to the ATO on an employee share plan statement called an ESS statement to report the actual taxable amount of your shares. And similar in America, under a W-2, it's often required to be reported by the employer on that W-2 how much you owe to each country. Now, what we see, I mean, first off, that isn't actually the source of the truth. That's the employer's understanding of the tax, which is obviously a very good starting point, and the ATO would often follow that treatment. But you do have the option to override what the employer does report to the tax office if it's not actually correct. And I think where we see it often not correct is where you do remain on different countries' payroll. In particular, if you go to say from US payroll, you're moving down to Australia, there's often no reporting from the US company to the ATO, but the taxpayer still has an obligation to pay tax to the ATO on any vests that happen in Australia. So yeah, I think if you do have employee share plans or options, definitely get in touch before the move just to make sure you understand where you're paying tax and when. And this sort of dives into my next really key point, and it's a really important one, I think, is when the taxing point actually occurs. And Australia is different to almost every other country in the world in that on the vesting date or exercise date of the options. In America, for example, normally there's withholding tax that applies at that time. So you're essentially paying that tax at the time of the taxing point. So you haven't got an issue of having to fund your own tax bill or worry about it down the track. Where Australia is very different is that you are required in Australia to declare the taxable gain in your Australian tax return and pay that tax when you file your Australian tax return, which is often sometimes 12 months after the taxing point. So in Australia, you're taxed on the market value of the shares you get at the vesting date or exercise date of the options, and that amount goes in your Australian tax return. The risk can be that if the share price of a company was to fall after that point, you may have a situation where you're taxed at a higher amount than the share price, which hasn't happened a lot recently with share prices increasing, but as John will probably elaborate on a bit later, it does happen, and it did happen a lot in the 22 market correction, if you want to call it. So I think just be mindful of that. There can be some merit to looking to sell down some shares to cover the tax bill at the vesting date. So that's, yeah, a really key point. The other key point on the taxing point is that, for public companies, it's normally always the vesting point is where you're taxed, or when you exercise the option, given the shares are liquid. But as Khandra mentioned, Australia's got similar rules to the US, where there's often a double trigger taxing point for private companies. So even if the shares have vested or options have been exercised, if you can't actually sell those shares because they're not liquid and the share plan restricts you from actually disposing of those shares or options, the taxing point doesn't actually occur until there's a chance or opportunity to dispose of the shares or options, which is normally a good thing because it does push the taxing point down the line further, which is great. But I think the other point would be just be mindful that when you do get an opportunity to sell, it's actually a taxing point, which sometimes can catch people off guard if you choose, not to sell those shares. You choose to keep them. There's still a taxing point when you've been given the opportunity at that time. So something just to be mindful of in Australia. I'll touch on the startup concession, and perhaps we'll come back to the startup concession in a moment, but it is a big concession in Australia and very, very lucrative for startup employees. And I guess that the benefit of that startup concession is that it's taxed under the capital gains tax regime in Australia. So it means that you get a 50% reduction on the income you include in your return. So that means the most tax you'll pay on a startup option or share is 23.5%, as opposed to 47%, which you would pay under a normal income tax plan. So really good news. And the other point is that the taxing points pushed all the way back to when you dispose of the shares. So there's no tax at vest or exercise. The only tax you pay is when you sell those shares in Australia, which is good news. There is some important American implications around that, which Khandra will touch on in a moment. There is a bit of a mismatch if you're on an Australian startup plan, how that ties into the American system. But I'll let her touch on that in a moment. There are some quite strict conditions to be met to satisfy the startup criteria for the company itself. It's really designed and targeted towards obviously early stage startups in Australia, where the shares need to be issued for effectively market value, or if it's an option for nil dollars, really, to make sure it's actually a company that has no value. But just make sure if you're in that space that the company's got advice to make sure that all the employees qualify for that startup plan. Just some other points in terms of how to perhaps mitigate the taxes in Australia. Because normally you include the income discount in your Australian return, that is taxable as income tax in Australia. You certainly want to consider making some concessional deductible super contributions each year to reduce that tax. And John will jump in later on to explain more, but you can effectively put in $30,000 per year as a pre-tax contribution to lower your taxes. If you haven't used that for 5 years, you can bring forward that over a 5-year period. So you may have up to $150,000 you can put in pre-tax to mitigate some of that ESS tax bill that you might have in Australia, which can be quite nasty, given it's really a 47% tax for most taxpayers. I'll quickly touch on the ownership structure as well in terms of how to best hold your employee shares. You've really got two options. One, which is definitely the most common, and 98% of the time we see it, is just holding them in your personal name, which is completely fine, often the right thing to do. But also an Australian trust could also be an option as well. And the Australian trust would be helpful in that it can mitigate any future CGT on the shares. So the income taxing point, if they're held in one's personal name or in a trust, does not change, because they're ESS shares. Even if they're held in a trust, the actual employee still pays the income tax on those. However, if you choose to actually hold the shares and they're in a trust, any future capital gains tax that might occur after the income taxing point can be effectively managed by the trust, and you can actually plan to have that capital gain paid out to a beneficiary on a lower tax rate than you down the track. So I think it's always a good option to have, I think, shares held in a trust if you have that choice and the employee is willing to do so. There's no harm in doing so, but only if you're in Australia. Normally, you would not want that if you're in America or you're a US citizen in Australia. Yeah, I might throw it back to John and Khandra to chip in.
Yeah, I think sorry, John, to interrupt, but yeah, I think a couple of key points, just to reiterate what Brad said. And I think it does really illustrate the complexity of being a US citizen that has this type of Australian plan, where a startup concession plan in Australia is so fantastic, but the IRS just simply does not care about it. It is not on their radar. It's not going to be taxed any differently than any other US plan. So we get into this awkward area where you might have a taxing point at exercise for US tax purposes on income that's being deferred a year or two down the track in Australia, and that can cause some real problems. So I'm working with a guy now who, you know, did the right thing in Australia, deferred his tax for so long, because that's what you do, but had to cut a check to the IRS for $735,000 and now has to also pay his Australian tax until we can amend the return and get the US payment back. So, you know, you just want to make sure that you're not going to be caught out like that in a cash flow sense. And then, you know, the strategy of, you know, making super contributions in Australia to reduce the taxation on ESS income, fantastic. But again, as a US citizen, there are going to be some limitations on how much you can put into super problems that might come up. So at every point down the line, there's just things to watch out for and to be careful of. So yeah, I think that's the message today, is just obviously take advantage of these plans. I think, as John mentioned, not everyone gets access to this type of compensation. So it's a great thing to have, but you just don't want to be caught out at any point in time. Yeah.
No, absolutely. And it's really important to consider, you know, there are some real major complexities on the US side, but as you know, Brad's alluded to as well, Australia is a very high taxing country as well. So it's working through and ultimately looking at your worldwide tax situation and ultimately working at how you can lower the worldwide tax bill and you know, there are some things like, you know, potentially putting a bit into super, potentially looking at a trust, but you've just got to make sure that those things, you know, will potentially cause some more problems on the US tax side of things. But you just got to make sure that any cost on the US side is going to be made up from a significant reduction on the Australian side, and worldwide, you're in a much better tax bracket. So we'll touch on that a little bit more in a second. But did you or Khandra have anything else to go through, Brad?
Look, yeah, I think I'll just add to that. Yeah, I think it's really important, I think, especially for expats moving between the two countries, just to be aware of when the taxing points are actually occurring from a cash flow perspective, as Khandra mentioned. Because, I mean, often, you know, the advice from the company or from their accounting firm is very much domestic focused normally in terms of when these taxing points occurred. We see some funny things when people move countries. And I think often the sourcing and reporting is not accurate. So I think even if you do have a ESS statement from the ATO or to the ATO, it doesn't always mean it's actually the correct or accurate outcome. So I think just make sure you're getting your advisor to double check that carefully as well.
Yeah. I think a follow up on that around moves issues we also see that I haven't mentioned yet come up at the state tax level, because I think although those rules in concept are very similar to the federal rules, a lot can change. Let's say if you move from Australia to a state like New York or California, you're receiving Australian ESS income, which at a federal level, we've got a federal tax treaty, an international tax treaty and a system of foreign tax credits to relieve double tax. We don't necessarily have that at a state tax level. So you could have a situation where you pay additional state tax on income that you've already paid tax on in Australia. And there's not a lot you can do to alleviate that. So you need to be comfortable around the timing of your move and understand what will happen when you move to a state that has income tax. And I don't know how often this happens. Brad and I have seen it a few times, but yeah, things like transferring with your company, but changing payroll, you know, are your shares going to get canceled and then reissued from the new entity? Are you going to stay on the same vesting schedule? You know, if you end up quitting your job or there's a layoff that occurs, do you keep your unvested shares? Do you have to forfeit them all? So, you know, you really need to understand the plan itself as well.
Yeah, that's a great point for sure. I think the other bit of good news news is that Australia had this nasty rule historically that if you cease employment, you got taxed on the actual options you had, even if they weren't vested or realised. Luckily, that was scrapped a few years ago, so do not have to worry about that one anymore, but that was a real killer, so that's good news. The other one, and actually a really important one we haven't spoken about, is when you leave Australia, there's normally an exit tax that applies. It doesn't actually apply to ESS income that has not vested yet or has not been taxed yet. So that's another common question we get. What happens to my vested or unvested stock when I leave Australia? Is a part of that exit tax? Good news, it's not, but still needs to be really factored in there carefully after that point to see any future US implications of it.
Beautiful. Thank you for that, guys. So just going through the financial planning considerations with employee shared schemes, and I guess it's really important to really just bring it back to basics ultimately, and factor it back into your financial goals, and really bring it back to your financial goals. You need to make some decisions on what you do, especially on vest of these shares. So it's really thinking about what are your financial goals, what are you hoping to achieve in your broader financial situation. We see a lot of the time that the financial strategy and the employee share schemes are kind of off on the side, that really aren't factored into the overall situation. So it's really thinking about often, if you have got financial goals like you're buying a house, or you're looking to fund kids' education, or whatever you might be looking to do, you need cash to do that. Ultimately, you need to factor these employee share schemes as part of your broader remuneration package, and how you're actually going to use the liquidity and the resources to fund these future goals. And it might require you selling. If you've got a longer time horizon, then potentially you are able to keep it, but you've got to really factor in that there's ups and downs in all asset prices, and really, if you're going to keep these shares, you've got to be prepared to keep them for the long term, because we never know when the next correction is going to come. Very topical at the moment with what's going on in markets, as I'm sure you're all seeing. So that's the first thing. The second thing there is the timing of any sale. So it's an important consideration. It sort of ties into that next point on the side about the unfunded tax liability, but it's also about, if you are looking to sell on vesting, that's great, because that offers you the ability to fund any tax liability and do some other things in your financial situation. So that's great. You probably want to be looking at what's going on in the company price, and if it's a horrible time in the market, maybe it is holding off at that particular point in time. You don't want to be realizing an asset at below its value. So if we're going through a really tough time in the market, then maybe it is holding off for that parcel of shares and waiting for things to get a little bit better. But I'll also caution in saying that you're not going to perfectly time the market. So you're not going to be able to sell at the absolute apex of the market and sell at the perfect point. So it's really, if we're talking about, another COVID crash or GFC type situation, or there's something specific with the company that has meant that the share prices really, crashed, and you're very confident that it's a temporary dip in the share price, then potentially it's holding off. But then if you do hold off, then it's important to consider that typically there's income tax on the vesting. Any growth from there forward is assessable, and it's potentially thinking about any growth component, once it vests, keeping it beyond 12 months. So both in the US and Australia, there's benefit in keeping any stock beyond 12 months, because you then get into long-term capital gains and also, concessionally treated capital gains tax in Australia, where, effectively you're going to be paying sort of 20 to 23% on the gains, depending on whether it's taxed in the US or Australia or both. But it's much better than paying tax at your marginal tax rate, which is what would happen if you sell within 12 months of vesting. So that's a consideration as well. So anything you keep potentially keeping it beyond 12 months to limit any tax liability. And then the unfunded tax liability that Brad talked about earlier is a really, really important consideration. We see it all the time, and it's so important to consider this, because ultimately what's happening is that it's ultimately just another part of your remuneration package that, especially in Australia, you're not seeing the tax withheld. So you've got to either sell on vesting to fund that liability. So you've got to act and actually sell, or you're going to need to use resources from elsewhere, either your surplus income or your savings, to fund that tax liability. And that can be problematic because, ultimately, looking at your broad financial situation, if you're looking at building a retirement, you're looking at paying down debt, you're looking at funding other costs, you're going to have to pull resources from those other goals and making sure that you're putting it towards these shares. So it's an important consideration to, again, look at things holistically and plan out that, as Brad mentioned, there can be a dip in the share price, and that may mean that you are paying a tax liability down the track at tax time to fund an investment that has dropped in share price. So consider whether it is just selling an equivalent that is equal to the tax liability. That can be a good strategy if you're really intent on actually just keeping the investments. But it's also it's also just considering whether you sell even more, which I'll go through in a second. And then structuring and planning is critical as well. We talked about potentially looking at family trusts. It is important to note, though, that if you are going to go down the path of a family trust, certainly speaking to the US and Australian accountant, if you're liable for taxes in both locations, because some of these strategies, as we've mentioned, may not work in Australia, but can be problematic on the US standpoint. So you've just got to make sure it works on both sides. I would say, in terms of family trust, if we're talking about $10,000, $20,000 of shares, and that's the extent of it, probably not going to stack up. You want to make sure that the cost and complexity is going to outweigh the or provide the benefit. But if we're looking at a share scheme that is, even if it is starting small but is going to grow, the key point is that, unlike in the US, where you can move shares into structures later, in the US system, there is the ability to move from your personal name into a structure, and often there isn't a taxing point at that point. In Australia, it is a taxing point. Anytime an investment is moving from your personal name into a trust structure, that is a capital gains tax point. So it's important to consider, even if, and it's unfortunate, but sometimes you've got to kind of set up the structure initially from the outset, have the shares in the investment or in the trust from the outset. It may not be worth its while in year 1 or year 2, but in year 10, year 15, it will pay itself off. So you've got to think from the start of these employee share schemes and getting the structure right from the outset, because down the track, it's going to be costly, potentially from a capital gains perspective, if you are to shift assets out of your name and try and get them into a structure then. The other thing as well that Brad mentioned, there are opportunities in Australia around super contributions, but again, just watching out for the US tax implications of that. So just making sure that it doesn't trigger a foreign trust treatment of your super or complicate the US taxes, because super is a very grey area for US taxes, and one that can be complicated with voluntary contributions, but it is certainly an option. And there is the ability to go back previous years for those that have super balances under 500,000 and haven't contributed a lot in recent years, or haven't maxed out their concessional pre-tax contributions. So it can be a great opportunity where you've had a big parcel of shares that are vested in one hit, and it's going to mean a really high tax liability. You can now utilise with catch-up contributions up to 5 years worth of concessional contributions that you haven't capped out of your concessional contribution cap, to contribute in 1 year to lower any tax liability in Australia. It won't work on the US liability. The US won't recognise that, but from an Australian perspective, it'll work. So again, it's speaking to all your professionals and making sure it stacks up really across the US, Australia, and your financial planning side of things. And then lastly, but almost most importantly, very importantly, that diversification is so important, and this is just a very common thing we see with employee share schemes. They're fantastic. They give you an opportunity to enjoy the success of the company that you're working for, but often there is bias. We see, in terms of individuals that work for a company. You're working in a company, you feel passionate about that company, you believe in its success, and I'm sure we're all working for companies that we love and believe in its success. Otherwise, you probably need to get on Seek and find something else. But ultimately, we tend to look at these things with rose-colored glasses. With the companies that we're working for, because we may, all our colleagues, all the management are talking the company up and how brilliant the company is. Share analysts and the share market may have a different perception on the future value of the company. So as with any of your financial planning, you've got to think about risk management and making sure that you do manage the risk around your situation. And there's no doubt, no matter what the company is, we can be talking about any company in the world, there is a risk that company could underperform or go through a period of time where there's, they're not performing or not growing at the pace of the broader market. So you just need to make sure that you're not too exposed to one particular investment. Diversification is king. So it's that old adage of not having all your eggs in one basket that I'm sure everyone's heard of. So it's not an all or nothing proposition either. And I think a lot of people love having some skin in the game and having a connection to the company. There's fear of missing out, and especially if you're working with these big tech companies that have just gone crazy over the last 10 years. It's hard to sell, but it is important to just manage your risk, and that no one knows what the future holds, and ultimately you can have a little bit and have a portion, but it's potentially just selling half or selling 3/4 and keeping some there. So if it does well, great, you've got some exposure. But if it does underperform or if it does drop, you've diversified away and bought some other assets with the proceeds of your share sell down. So that's pretty well it. I think it is, with all of this, importantly, I think, as we've alluded to, the best of times, you should be speaking to your professionals. There are various tax and financial planning considerations, but I'm sure you can see for US Australians, there are some really key overlaps that happen, and you can get it wrong with some really common financial strategies and really common, treatments of employee shares. So having a team that all understand how the US and Australia treat these employee shares is critical. So that's that I think is a key point in all of this. So that was it in terms of the content. So we'll move on to the Q&A section now. I think we've got some questions here. So there's a question in relation to how does the US treat Australian ESS startup concessions? How are the taxing points different?
Yeah. So generally, for an option, the US will tax it essentially as wage income on the date of exercise. And because of the way the US foreign tax credits work, where we have to isolate taxes that are paid on wage income versus isolating the taxes that are paid on capital assets or CGT tax, we can see some pretty terrible mismatches there. So there are some ways to mitigate the impact of having a startup concession plan on the US tax return. But unfortunately, you're as a US person, you're just not going to get the same good deal that your Aussie coworker would. Yeah.
Perfect.
Yeah, I think too on the startup concession, it's always a interesting one, this one, because normally for an Australian resident that sells a startup plan, as mentioned before, you get that 50% discount. So you're paying effectively a 23.5% tax rate on the shares, which is great. Yeah, it can be like potentially even better. Because the way this plan works, if you're a non-resident of Australia, when you sell the Australian startup plan, like potentially, just depending on a lot of factors, it may not be subject to Australian tax at all. Depending on what you did when you left Australia and when you exercise the options. But it can be a sort of funny mismatch where you may have no Australian tax to pay on an Australian startup plan. So yeah, then it obviously ties back to the American system, how the US would treat it, which is just important to get that timing right.
Yeah. And I'm not sure if there would be any founders on the call, US citizen founders. I mean, there's a whole kind of host of other issues that come up, especially if you've got anywhere between sort of 10 to 50% of the shares in this private entity. So yeah, important at the really early stages of your startup to get personal income tax advice in both countries. Yeah.
Brilliant. And so it looks like there were a few other questions, but I think we answered those along the way in the presentation. So Brad and Khandra, do you have anything else that you wanted to add?
No, I think we covered the key points. I think it's obviously a huge topic, and I think if anyone's got any questions, just please get in touch with myself or Khandra, or I'm sure John would be happy to help as well, and we can obviously have a more detailed chat about your circumstances.
Perfect. So that's it. So we'll send a communication in the coming days with a copy of this presentation, a video to watch it back, if any of those wanting to watch it again. And also just we'll have our contact details as well. So if you want to reach out to any of the panelists, you'll be able to do so. But thank you, Brad and Khandra, for joining us today.
Yeah, thanks for having us.
Thanks for having us, John.
And thanks for those joining in, and have a great evening if you're in the US, and a great rest of your day if you're in Australia. Thank you very much. See you later.
See you, Brad.
Bye.